2025, stocks are up, housing is up, even gold is up. Normally, when risk assets go up, safe haven assets should fall. But right now, both are flying, safe and speculative assets together. ETFs alone pulled in over $900 billion in just the first half of the year, up 25% from last year. And with so much money looking for somewhere to go, issuers stepped in to create emerging market bonds. In just 7 months, issuance hit the fastest pace since 2021. And the risk premium versus US Treasuries? Now at the lowest point in almost 20 years. The market is basically saying, emerging market debt is almost as safe as US debt. On the surface, it looks as if emerging market risk has fallen. But in reality, this is only the market pricing down the perception of risk. The real political, fiscal, and external debt risks are all still there. So the question is, why are investors acting so aggressively? Is it because they truly believe risk has gone down, or is there another reason? The answer lies in rate cut expectations. The market broadly believes that the US will cut rates in the future. Buying bonds while rates are still high means locking in future returns. For issuers, it means borrowing at a lower cost. So, investors and issuers, their incentives line up perfectly. This situation naturally reminds people of the 2013 taper tantrum. Back then, the Fed merely hinted at tapering its stimulus. That alone triggered massive capital outflows from emerging markets. Countries heavily reliant on US dollar borrowing, like Indonesia, India, and Brazil, saw their currencies plunge. External debt pressure soar, and bond markets fall into panic. By contrast, today is very different. This time, the expectation is for rate cuts. So instead of fleeing, capital is rushing into emerging market bonds, eager to lock in returns while yields are still high. But the similarity is this: investors are still scrambling for timing. Afraid that if they are one step late, they'll miss the best entry point. The biggest buyers are large institutional investors, pension funds and insurance companies, often allocating 2 to 8% of assets into emerging market debt. Mutual funds and ETFs act as the bridge for retail investors, while hedge funds focus on short-term bets, profiting from spread compression. So this isn't just speculation, it's massive, long-term capital, moving in together. The most interesting part is this: so much money is flowing around the world, willing to chase just an extra 1 or 2% in emerging markets. Yet some so-called mature markets are almost completely ignored. Why? I explained in my last video, check it out if you're interested. Because investors know, money seeks growth and vitality, not systems locked in stagnation. This phenomenon shows one thing: there's simply too much money in the market today. Most mainstream assets are already crowded, or priced too high to chase. So capital has no choice but to push issuers to keep creating new products, just to absorb all this excess liquidity. On the surface, tighter spreads and booming bond sales look like safety. But the risks haven't disappeared. Once political instability, external debt pressure, or a stronger dollar hits, capital can exit overnight. It rushed in quickly, but it will rush out even faster. This looks a bit like CDOs before the 2008 financial crisis. Back then, people believed that by diversifying and repackaging, risk was eliminated. In reality, it was just mispriced and hidden. Emerging market bonds today show a similar problem. Profits are locked in, but the real risks remain. Specifically, the risks come from high fiscal deficits. Many emerging markets rely on external borrowing. If the dollar tightens, the pressure explodes. Currency depreciation. Once local currencies fall, debt repayment costs surge. Political instability. In Latin America, Africa, and parts of Asia, political cycles often lead to restructurings. Liquidity risk. Unlike treasuries, when panic strikes emerging bonds, there just aren't enough buyers to absorb the sell-off. Still, today is not exactly the same as CDOs. The CDO problem was risk amplification, which eventually dragged down the banking system. In emerging market bonds, the main risk is capital flow reversals. So the similarity is in the mispricing of risk. The difference lies in scale and transmission channels. So, this bond frenzy is not necessarily good, but it's certainly not harmless either. It reflects the market's hunger for returns, and reminds us of one thing: when everyone believes it's safe, that's often when the real danger begins.